proportionate input tax credit. Now friends, if there is any input tax credit, that means any inward supplies of goods and services which are used in the course of furtherance of business exclusively for making taxable supplies, you can take 100% credit. Exclusively for making zero rated supplies, you can take 100% credit. So zero rated supplies are always along with taxable supplies as regards as proportionate input tax credit is concerned. If they are used exclusively for non-business purposes, you cannot take any credit. If they are used exclusively for making exempt supplies, you cannot take any credit. But however, if inward supplies of goods or services are used for taxable as well as exempt, if there is some common credit which is being used for taxable as well as exempt supplies, then the procedure is you can take 100% credit. Initially, you can take 100% credit, and thereafter, to the extent it is being used for making an exempt supply, it needs to be added back to your output tax liability. Now, there is a change in this portion what we are discussing. Any input tax credit which is being used for making taxable as well as an exempt supply, first you take 100%, and then to the extent it is being used for making exempt supply, you need to add it back to the output tax liability. Now, how are you going to find out to the extent it is being used for making an exempt supply? So, there the formula which is being given in explanation to rule 42 and 43, in rule 42 and 43, it tells you value of exempt supplies. What is the addition? To what extent you need to add back to the output tax liability? It is value of exempt supply divided by turnover in the state. Value of exempt supplies divided by turnover in the state multiplied by common credit. The common credit is the credit which you have used for making taxable as well as exempt supply. So, this is the basic what we have discussed. Now friends, what do you mean by value of exempt supply? What is meant by value of exempt supplies? So, now friends, as regards as exempt supplies, the value of exempt supplies is concerned, here there is a special provision which is there. The normal exempt supplies what we understand, that is 1, it is 100% exempted, 2, it is nil rated supplies, third one, it is non-taxable supplies. These are the exempt supplies which are there. Now, what do you mean by value of exempt supplies? Explanation to rule 42 and 43, which tells you the value of exempt supplies other than the normal thing. That is, this normal thing is going to be there in value of exempt supply. You will have 100% nil rated, 100% exempted, nil rated and non-taxable supplies. Now, it tells you it will include certain things in the value of exempt supplies and it will exclude certain things in the value of exempt supplies. I repeat again, explanation to rule 42 and 43, it tells you exempt supplies means the regular thing is obviously going to be there. Apart from that, there is going to be certain additions in the so-called value of exempt supplies and there are going to be certain deletions in the so-called value of exempt supplies. Now friends, please visualize, whenever there is an addition in the value of exempt supply, whenever there is an addition to the value of exempt supply, in that case, is it a loss to the registered person or is it a gain to the registered person? Friends, please understand, value of exempt supplies, they tell it will include something more. That means the numerator will increase. Now, this is the amount of output tax liability which you are supposed to add. Now, when I say that this value of exempt supplies will include some more things other than these three normal things, that means my numerator will increase. Now, when my numerator will increase, ultimately the answer which I am going to get is going to be more than it would have been had these additions not been there. So, therefore, my addition to output tax liability will increase. So, that means why certain specific additions are required? It is not covered over here, but the government wants to consider them equivalent to exempt supplies so that there is an increment in the addition to output tax liability. There are certain omissions in the value of exempt supplies, from these normal things, there are certain omissions. Now, why there is omissions? What effect does this omission have when the value of exempt supply will exclude something? It is an exempt supply, but for the purpose of calculating addition in output tax liability as per rule 42 and 43, there are certain omissions from the value of exempt supply which will decrease your numerator. And when your numerator decreases, the answer you are going to get is going to be comparatively on a lower side. Effectively, there is less addition in output tax liability. So, these deletions which are there, it is beneficial to the registered person because his output tax liability is going to decrease. So, now friends, having said this, there are certain amendments in the decreased portion. That means it will exclude certain specific things. Otherwise, it does form as per the normal definition of exempt supply. As per the normal definition of exempt supply, it is included in the exempt supply, but specifically rule 42 and 43 is removing them from the value of exempt supply. In these exclusions, there is an amendment. So, here we go. Explanation to rule 42 and 43. What is the amendment? Friends, it excluded central excise, state excise, VAT and CST. Explanation to rule 42 and 43. It excluded central excise, state excise, VAT. CST was accidentally omitted to be mentioned in rule 42 and 43. I repeat again, prior to amendment, central excise, state excise and VAT was there. CST was accidentally omitted. Now, CST also has been included in explanation to rule 42 and 43, wherein it tells that these following things are excluded from the value of exempt supply. Say for example, there is a person. Now friends, what are those products which attracts VAT and CST? Now friends, let's suppose there is a person who is supplying alcoholic liquor. Now is alcoholic liquor inside GST or outside GST? It is outside GST. What will it attract? It will attract your state excise duties, and obviously it will attract your VAT and CST. Now let's suppose there is a person who is supplying alcoholic liquor. There is a person who is supplying alcoholic liquor and he is also supplying cool drinks. Person who is supplying alcoholic liquor and also supplying cool drinks. Alcoholic liquor is outside GST, cool drinks is inside GST. Now friends, there is some common credit. There is some common credit which is being used for making a non-taxable supply as well as making a taxable supply of cool drinks. Now friends, you will take the entire credit of this common credit and thereafter you are going to add something back to the output tax liability. Now what is the addition you are going to do? It is going to be value of exempt supplies divided by turnover in the state multiplied by common credit. Now friends, as regards this value of exempt supply is concerned, now let's suppose your alcoholic liquor which you have supplied, let's suppose you have supplied this outside the state. You have made an interstate sale of this alcoholic liquor. Now the interstate sale of this alcoholic liquor, let's roughly assume it is 100 rupees plus some 25 rupees CST. It is 25 rupees CST sale of this alcoholic liquor outside the state, which happens to be 125. And this cool drinks what you have been sold, let's roughly assume it is some 200 rupees plus 56 rupees GST. Now friends, value of exempt supply divided by turnover in the state. What is value of exempt supply? The general thing it told you, nil rated, 100% exempted, non-taxable supply. Now what is non-taxable supply? Do you think alcoholic liquor is a non-taxable supply? The answer is yes. What's its value? Its value is 125. The valuation is 125 as per the general terminology of exempt supplies. However, explanation to rule 42-43 prior to amendment, I repeat again, explanation to rule 42 and 43 prior to amendment, there was an accidental omission of CST. It was not intentional because had the same alcoholic liquor been sold inside the state, it would have been 100 rupees plus 25 rupees VAT. There the explanation told you it shall exclude VAT. That means if you would have sold this alcoholic liquor inside the state, the value of exempt supply would have been only 100 because it did not include CST, it did not include VAT, but it included CST. Now friends, prior to amendment, We'll take a situation where prior to amendment it was sold outside the state. So then the value of exempt supply would have been 100 plus 25, because the value of exempt supply, explanation to rule 42 and 43, it told you value of exempt supply shall not include central excise, state excise and VAT. It was silent about CST. So therefore it would have been 100 plus 25 prior to amendment. Post amendment, the value of exempt supply. Post amendment, the value of exempt supply is going to be, it is going to be 100. Value of exempt supply is going to be 100 because it excludes CST as well. Now friends, this is as regards as the numerator is concerned, value of exempt supply. So you get value of exempt supply post amendment as 100 divided by turnover in the state. Now friends, do you think when the value of exempt supply is excluding CST, the turnover in the state should also exclude CST, only then it will be in an aligned manner? The answer is yes. So you will note that in the subsequent slides to see that even the turnover in the state will exclude the CST portion. So now friends, what is going to be the turnover in the state? It is going to be 100 rupees plus cool drinks 200 rupees. You will not include this 56 rupees GST because for the purpose of valuation according to section 15, it will include all taxes excepting GST. So therefore, the value of this taxable supply is going to be only 200 rupees. So this is going to be the scenario post amendment. So friends, the sum and substance is only so much. There was an accidental omission of CST in the definition of value of exempt supply, special definition of value of exempt supply in rule number 42 and explanation to rule number 42 and 43, and also in the turnover in the state there was an accidental omission of CST which they have rectified. The next thing is supply of services to Nepal and Bhutan against INR. Now friends, prior to the amendment, now before going this, let us discuss what do you mean by export of services. I repeat again, before discussing this amendment, let us have a discussion as to what is meant by exportation of services. Friends, if you are satisfying conditions, there are certain conditions which are there in the IGST law for a transaction to qualify as an export of service. The service provider should be from India. Export of service has been defined, section 2 clause 6 of the IGST Act. The service provider should be from India. Service recipient should be outside India. The place of supply should be outside India. You should receive the consideration in forex, and the supplier and recipient should not merely be distinct persons. Now friends, let's take a scenario where the services are being supplied to Nepal and Bhutan. You supply some consultancy services to Nepal and Bhutan, and against which you are receiving an amount in INR. Does it happen to be an export of service? Service provider in India agreed, recipient outside India agreed, place of supply outside India agreed for consultancy services. Consideration you have received in INR and not in forex. Does it amount to export of service in accordance with section 2 clause 6 of the IGST law? The answer is no. It is not an export of service. If it is not an export of service, what supply it is? It is an interstate supply. Location of supplier in India, place of supply outside India. It happens to be an interstate supply of service wherein IGST needs to be paid. But however, there was an exemption which was being issued. There was an exemption notification being issued under the IGST law. Under section 6 of the IGST Act, exemption notification is being issued which told you that where the supply is being made to Nepal and Bhutan, where the place of supply is in Nepal and Bhutan, in such cases, these services are going to be exempted. Friends, please remember the sequence. It is not an export of service. That means it is not a zero rated supply. That means you have to pay IGST because it is an interstate supply. But do you effectively pay it? The answer is no. You do not effectively pay it because it is exempted. Now friends, it is exempted. So that means, does it become an exempt supply? The answer is yes, it becomes an exempt supply. Now let's suppose, take your profit and loss account. In your profit and loss account, you have, let's suppose, services to Nepal. Services to Nepal, 100 rupees. And let's suppose services in India, 500 rupees. Now this is on your income side. And you have certain common expenditure, let's suppose some audit expenses there, on which GST is being paid of 18 rupees. Does this become common credit being used for making a taxable supply as well as an exempt supply? Service in India, you need to pay GST. Services to Nepal, not export, not zero rated. IGST is chargeable. However, there is an exemption notification. Therefore, effectively, you do not pay any GST. Does this become an exempt supply? The answer is yes. So now friends, this is a common credit which is being used for making an exempt supply as well as taxable supply. So now, what the formula should have been for, first you will be taking the entire credit of 18 rupees and thereafter you will be adding something back to the output tax liability. So how much you are supposed to add back? It is going to be common credit multiplied by value of exempt supply divided by turnover in the state. So now had you gone by the normal definition of value of exempt supply, you would have taken common credit is 18 rupees multiplied by service to Nepal 100 rupees because it is exempted divided by 500 rupees. Sorry, divided by 600 rupees which is the turnover in the state. So now friends, here divided by turnover in the state which is 600 rupees, this would have been the scenario. But however, explanation to rule 42 and 43 told you that while considering the value of exempt supply, do not take services to Nepal and Bhutan when you are receiving the consideration in INR. So hence, before to the amendment, even though it was exempt supply, it was removed from the value of exempt supply according to explanation to rule 42 and 43. So therefore, you did not take services to Nepal and Bhutan inside the value of exempt supply. So it would have been 18 rupees multiplied by 0 divided by 600. So nothing was required to be added to the output tax liability. This was the position prior to the amendment. What is amendment which is being done? Amendment which is being done is, as regards as export of services concerned, this amendment is linked to the amendment in IGST law. As regards as export of services is concerned, even if you are receiving consideration in INR wherever permitted by Reserve Bank of India, it will still amount to an export of service. Even though you are receiving consideration in INR, wherever permitted by RBI, it will still amount to export of service. So now friends, when it amounted to export of service, now come back to our example, you supply services to Nepal and Bhutan, receiving consideration in INR and it is permitted by RBI, it becomes an export of service, it is zero rated supply. Now friends, as we already discussed in the beginning, zero rated supplies are always clubbed along with taxable supplies for the purpose of proportionate credit. So now friends, you have the same scenario, GST paid on audit fees, let's suppose 18 rupees, services to Nepal, amount received in INR permitted by Reserve Bank of India, it is a zero rated supply and this is a taxable supply. Is this 18 rupees a common credit? The answer is no, because now this 18 rupees is being used for making taxable supply and a zero rated supply. So hence it is not common credit anymore. It is used exclusively for making taxable supply and zero rated supply, wherein you can take the entire input tax credit. Scenario has totally changed. Now since these services have become zero rated, there is no requirement anymore for explanation to rule 42 and 43 to tell that supply of services to Nepal and Bhutan against INR will not form a part of value of exempt supply, because now it has become a zero rated supply due to the amendment in the IGST law. Friends, earlier this was there to encourage the exporters. Why encourage the exporters? Because when services are supplied to Nepal and Bhutan against INR, it was not export. When it was not export, it was taxable, tax should have been paid. But however, the government, to encourage it, it had exempted. But now encouragement was only on the output side. The moment you exempt it, all your credit becomes common credit. Addition to output tax liability gets warranted. So therefore, the government encouraged not only from output tax liability side, but also from the point of view of input tax side, wherein effectively when you work out the formula in common credit, from the value of exempt supply, they removed it. So effectively, there was no reversal which was required prior to the amendment. After amendment also, there is no reversal required, but there is no more role of explanation to rule 42 and 43 to remove the supply of services to Nepal and Bhutan, because these have now become a zero rated supply. So these are the changes which were there in explanation to rule 42 and 43. Accident omission of CST has been rectified. This supply of services to Nepal and Bhutan against INR is no longer required because it has become a zero rated supply. Now friends, let me give you a situation. Now let's suppose in your profit and loss account, you make a high C sales. I suppose you remember what is high C sales. You make a high C sales, you make a supply of drop shipment. I suppose you remember what is drop shipment, where the goods from one taxable territory goes to another non-taxable territory without entering into India. So IC sales and drop shipment, and if you could recollect, both of these are schedule 3 items. Now friends, this IC sales and drop shipment, let's suppose it is 200 rupees, this drop shipment is 300 rupees, and you have other local sales on which GST is going to be paid. Here no GST is being paid because it is a schedule 3 item. Local sales on which GST is going to be paid 1000 rupees. You have audit services on which GST paid is 18 rupees. Now friends, the question is, first of all, is it common credit? First of all, is this common credit? When do you call a credit as a common credit? When it is going to be used for making a taxable supply as well as an exempt supply. When it is going to be used for making a taxable supply as well as an exempt supply. Can you call this high C sales and drop shipment as taxable supply? The answer is obviously no. Can you call it as an exempt supply? Friends, what is the definition of exempt supply? It tells you 100% exempted. Is it 100% exempted? The answer is no, because 100% exempted should come by an exemption notification. It is nil rated. The answer is no. It is not nil rated also, because this has to come through a notification. Now, it is neither 100% exempted nor it is nil rated. Can you tell it is a non-taxable supply? What is the meaning of non-taxable supply? Non-taxable supply is a supply of goods or services on which there is no levy of GST at all. Now friends, please analyze carefully. For a supply to be non-taxable supply, first it should be a supply. For a supply to be a non-taxable supply, it should be a supply. And in GST, supply can be only of goods or services and nothing else. Supply can be only of goods or services or both and nothing else. Now friends, what is the title of schedule 3? The title of schedule 3 tells you the following activities are neither a supply of goods nor a supply of services. The following activities are neither a supply of goods nor a supply of services. So now friends, the question is, when high C sales and drop shipment is neither a supply of goods nor a supply of services, and in GST supply can be only of goods or services or both, it doesn't form into the definition of supply at all. When it is not a supply at all, how can it be called as a non-taxable supply? It cannot be so. So therefore, it is not a non-taxable supply as well. High C sales and drop shipment, it is not a non-taxable supply. Effectively, it is not an exempt supply. Now, when it is not an exempt supply, you have certain credits. Is it used for making taxable supply? Yes, it is used for making local sales. Is it used for making an exempt supply for it to be called as common credit? The answer is no, these are not exempt supplies. So therefore, is there any addition to output tax liability which is warranted? Technically, the answer is no, because these are not exempt supplies. Hence, there is no addition to the output tax liability which should be made, because now there is nothing called as common credit. Friends, when will this 18 rupees become common? Only when it is used for making taxable and exempt supplies. Otherwise, it loses the color of common credit, or rather, it does not attain the color of common credit at all. A credit attains the color of common credit only when it is being used for making a taxable as well as exempt supplies. These are not exempt supplies. So the same thing has been clarified by means of an explanation to section 17 subsection 3. It tells you, value of exempt supply shall not include the value of activities or transactions which are specified in schedule 3. So friends, there was a confusion which was there. The interpretation what we have taken has come in the form of an explanation to 17 subsection 3. It simply tells you the value of exempt supplies shall not include schedule 3 transactions. But read further, except those which are specified in paragraph 5 of the said schedule. So excepting paragraph 5 of the said schedule, other activities, are not to be reckoned in the value of exempt supplies. Now friends, what is paragraph number 5? It is sale of land and building subject to paragraph 5b of schedule 2. So this sale of land and building alone will be included, even though sale of land is neither a supply of goods nor a supply of services according to schedule 3 of the CGST Act. But the same CGST Act explanation to section 17 subsection 3 tells you that value of exempt supply will include sale of land. I repeat again, schedule 3 tells you sale of land is neither a supply of goods nor a supply of services. Where it is told? It is told in schedule 3 of which act? CGST Act. The same CGST Act explanation to 17 subsection 3 tells you, for the purpose of reckoning value of exempt supply, all items of schedule 3 we leave it, but we will not leave paragraph number 5. So now, keeping that in mind, there is no amendment in this. This was already there. The explanation is new. But here in 17 subsection 3, an explanation to chapter 5 of input tax credit rules, there are certain additions which are being made. In that additions, if you look, sale of land and building where entire consideration is received after the receipt of completion certificate, this will be included in the value of exempt supply, because explanation to section 17 subsection 3 specifically tells you we will leave all the schedule 3 items, but we will not leave paragraph number 5. So if there is a sale of land and if there is a sale of building after the completion is complete, that we will include it in the value of exempt supply. That means once it becomes once it is included in the value of exempt supplies, your credits attain the color of common credits, and then it will warrant addition to output tax liability. So friends, what is the summary? The summary is the schedule 3 transactions, this transaction alone, rest all the other transactions will not warrant any output tax liabilities addition, because the credit doesn't attain the color of common credit, excepting sale of land and building, which is there in schedule 3. As regards as this is concerned, explanation to 17 subsection 3 tells you, however, as regards as paragraph 5 of schedule 3 is concerned, that will be considered while computing the value of exempt supplies, warranting addition to the output tax liability, because now the credit becomes common. Say for example, there is a builder, same case we will take, 18 rupees GST is being paid on audit fees. There is a builder, he has got sale of flats which are constructed. Sale of flats which are constructed, that means the entire consideration is received after completion. Sale of flats 100 which are completed. Sale of flats which are being sold before the completion is being done. That means he receives an advance even prior to the completion. Let's suppose that is 200 rupees. Now friends, this sale of flat 100 rupees is actually, it is a schedule 3 item. So therefore, it is neither a supply of goods nor a supply of services. When it is neither a supply of goods nor a supply of services, it is not a supply, because supply can be only of goods and services. When it is not a supply, it is not a non-taxable supply. When it is not a non-taxable supply, it is not an exempt supply. When it is not an exempt supply, here this 18 rupees doesn't attain the color of common credit. This was the general understanding. However, explanation to 17 subsection 3 read along with CGST rules tells you schedule 3 we will leave everything excepting the sale of land or sale of building after the completion is complete. So now this will be reckoned, this will be included in the value of exempt supplies. So now your value of exempt supplies will become 100. Without the explanation, it wouldn't have been so. Value of exempt supplies is 100 divided by total turnover is 300, multiply common credit 18 rupees. This is going to be the addition to output tax liability. Next, turnover in the state. Friends, value of exempt supplies, there was an accidental omission of CST. That accidental omission is rectified in the value of exempt supplies in the numerator, also in the denominator. The accidental omission has been rectified, and here from the denominator also they will exclude the CST portion because it is excluded in the numerator portion. Next amendment, section 18, availability of input tax credit in special circumstances. Friends, there could be a scenario where initially you are eligible for input tax credit, but later on you become ineligible because you choose to pay taxes under the composition scheme, or the products which you are supplying become exempt supply. Initially they were taxable when you availed credit, but now they become an exempt supply. It could be a vice versa scenario as well. Initially, you are not eligible for credit because that time your product was exempted, or that time you were opting to pay taxes under section 10, the composition scheme. But later on, you switch gears, your product becomes taxable, or you start paying taxes under the regular scheme section 9. So you become eligible for credit. So friends, after the initial availment, there are certain situations which arise, which warrant a relook at the credits which are taken, or a relook at the credits which are not taken. So friends, those scenarios are shift from non-taxable to taxable. That means from composition you come to regular, from exempt you come to taxable, or you are not registered and now you take registration. Scenarios where shift is required, taxable to non-taxable. You are operating under regular scheme. From 1st of April, you choose to pay taxes under the composition scheme. There is inventory which is lying on hand on which credit was already taken. From exempt, your products become taxable. You are registered, and your registration, either you apply for cancellation or the proper officer cancels your registration. There could be transfer of business, sale of business, there could be demerger. So in case of transfer of business, how about transferring credit from the old entity to the new entity? And at last, there could be sale of capital goods. Now friends, amongst this, the area of our interest as regards this amendment is concerned. Now friends, in case you are operating under regular scheme, that means you are paying taxes under section 9. From 1st of April, you start paying taxes under section 10. You choose to pay taxes under the composition scheme. Are you supposed to reverse the credit while choosing the composition scheme of the inventory which is lying on hand? The answer is obviously yes. There is no amendment. This is only the raw material what we are discussing for discussing the next amendment. Now friends, this section 18 which is there, it uses the word when you shift. That means you being a regular person, now you choose to pay taxes under section 10. Now friends, what about a person who was paying taxes under section 9? Now he starts paying taxes under notification number 2/2019 central tax rate. That is 6% on outward supplies of goods and services. Now here also in this notification there was a condition that taxes cannot be collected, ITC cannot be taken, the same conditions what were there in the composition scheme. But section 18 doesn't use the words that from paying taxes under the regular scheme you shift and start paying taxes under the composition scheme. It uses, but it doesn't tell you being a normal taxable person, you start paying taxes under notification 2/2019 central tax rate. Now when these wordings are not used in section 18, where is the authority for the government to tell that when from paying taxes under section 9 you shift to pay taxes under 2/2019 central tax rate, you have to pay the credit of the inventory which is lying on hand? Section 18 doesn't authorize so. But please have a look at notification number 2/2019 central tax rate. Entry point. We have discussed this again. We have discussed this already when we discussed this notification 2/2019. Friends, please understand, time and again we are repeating this. This is not a composition scheme. This is payment of taxes under notification 2/2019. Had this been composition scheme of section 10, this clarification or this point of discussion would not have arisen at all. This is not a composition scheme of section 10. So it tells you where any registered person who has availed of ITC opts to pay tax under this notification, he shall pay an amount by way of debit in the electronic credit ledger or cash ledger equivalent to the credit of input tax in respect of inputs held in stock and inputs contained in semi-finished or finished goods and on capital goods, as if the supply made under this notification attracts the provision of section 18 subsection 4. So friends, this 2/2019 makes it very clear that you just treat it as if this notification or this supply which is being made under this notification will attract the provisions of section 18, and accordingly you have to make a reversal of credit before you opt to pay taxes under 2/2019 central tax rate. Now friends, please understand one thing. As regards this 2/2019 central tax rate is concerned, this aspect, it only covers a scenario where you are paying taxes under the regular scheme. From here, you shift to pay taxes under 2/2019 central tax rate. The government is asking you to pay as though the supply made under 2/2019 will attract the provisions of 18 subsection 4. But friends, the government has discussed this from their point of view. What about the reverse scenario? You are paying taxes under 2/2019 central tax rate. From now, you shift to the regular scheme. You do not continue to pay taxes under 2/2019. Now you have inventory on hand. Section 18 in this scenario, it told you from a composition scheme, if you become a regular person, you can take credit. But here friends, 2/2019 central tax rate speaks only from the government's point of view. That means from regular, when you come to 2/2019, you have to pay the credit. But from 2/2019, if you go to regular, this 2/2019 becomes silent. It becomes mum on it, it doesn't say anything. But however, we have a recourse, we have a solution. There's an explanation 3. Keeping this provision in mind, we can apply the rule that when you're shifting from 2/2019 to the regular scheme, you can take the credit also. Even though this 2/2019 central tax rate specifically doesn't cover this. It specifically covers only that situation which is beneficial to the government. However, explanation 3 to the same notification, we can take the benefit of this explanation 3 and interpret it and apply it that as though even in case of shifting from 2/2019 to the regular scheme, you can avail the credit as you do so in the composition scheme. Let's have a look. It tells you the CGST rules 2017 as applicable to a person who is paying taxes under section 10 of the said act shall mutatis mutandis apply to a person paying taxes under this notification. So friends, the entire CGST rules 2017 as they are applicable for a composition taxable person will apply to a person who is paying taxes under 2/2019. Now friends, when you come to rule number 40, rule number 40 tells you that whenever a person who is paying taxes under the composition scheme shifts to the regular scheme under section 9, he can avail credit. So rule 40, how it is applicable for a composition person will equally apply for a person who is paying taxes under 2/2019 central tax rate. So friends, the bottom of the discussion, the conclusion happens to be this. While you are shifting from a regular person to 2/2019 central tax rate, 18 subsection 4, the provisions will apply. Notification 2/2019 expressly covers this. However, the vice versa case, shifting from 2/2019 central tax rate to the regular scheme, the credit which is there in the inventory which is lying on hand, you can still take it even though not expressly provided in the notification, but taking recourse from explanation 3, which tells you the provision of CGST rules as applicable to section 10 will also apply to a person who is paying taxes under 2/2019 central tax rate. The next scenario friends, as regards transfer of business is concerned. Now friends, in transfer of business, in case of demerger, let's suppose this ABC Limited which gets demerged into A Limited, B Limited, C Limited. In this case of transfer of business, what you already know is the electronic credit ledger balance of ABC Limited needs to be apportioned, will be transferred in a ratio to A Limited, B Limited and C Limited. What is that ratio? The ratio is to the extent of assets. The ratio is to the extent of assets which are transferred to A Limited, B Limited and C Limited. Now friends, a question which comes up is, now it tells you that it will be apportioned to the ratio of assets which are being transferred to each of the entities. The question is, does this asset include all assets or only those assets on which input tax credit was availed? Say for example, now this ABC Limited has got 300 rupees in its assets which are supposed to be transferred to A Limited, B Limited and C Limited, assuming it is transferred equally in the ratio of 100, 100 and 100. However, in this 100, 100 and 100 what is transferred to A Limited, B Limited and C Limited, here there is 25 rupees worth land which is being transferred to A Limited. As regards as B Limited and C Limited is concerned, no land is being transferred. All inventory or other fixed assets on which input tax credit was availed is being transferred. Now, what is the ratio in which you should distribute the credit balance which is lying in the electronic credit ledger of ABC Limited? Is it going to be in the ratio of, here out of 100, 25 belongs to land on which no input tax credit was involved, because on purchase of land obviously no GST is being charged. So should you transfer it in the ratio of 75 is to 100 is to 100, or should you transfer it in the ratio of 100 is to 100 is to 100? So the question is, when you are going to apportion this in the asset ratio, the asset which we are speaking about, is it the asset according to the accounting parlance, or is it only those assets on which ITC was availed? So friends, here you have a clarification. The value of assets means the value of entire assets of the business whether or not input tax credit has been availed. So now friends, this is what has been introduced in rule number 41. It tells you the value of asset means the entire value of asset. So in our example, it is going to be 100 is to 100 is to 100. In this ratio, you need to transfer the balance which is lying in the electronic credit ledger from ABC Limited to all these three entities. Transfer of credit on obtaining a separate registration. Now friends, as we have already seen, if you are having multiple places of business, you can obtain multiple registration at your option in a single state. Now let's suppose friends, there was a person who was having two places of business. There was a person who was having, okay, let's keep it as 3. There was a person who was having 3 places of business, but however, he was having only one GST number. He was having only one GST number for his 3 places of business. Now in the place of business 1, he kept this as principal place of business. This was additional place of business. This was additional place of business. For all these 3 places of business, he had one GST number. Now when the GST Amendment Act came into force, he got to know that for each place of business at his option, he can apply for a separate registration. Now what it does is, this first GST number, he keeps it for his principal place of business. He obtains a new GST number for second place of business, another new GST number for his third place of business. So now this one GST, it gets converted into 3 GST of the same PAN number. They become distinct persons. Any supply which is being made by them is going to be deemed supply in accordance with Schedule 1. All that is fine. Now friends, the question is, initially when he had only one GST number for 3 places of business, let's suppose his balance in the electronic credit ledger was some 10 lakh rupees. Now friends, he has obtained 2 different registration in the same PAN number. So now this one GST gets converted into 3 GST numbers. Now just in the previous slide we had seen, in case of sale, in case of demerger, in those cases, electronic credit ledger balance from the old entity gets shifted to the new entity in the asset ratio. Was that optional or mandatory? That was mandatory. In case of demerger, you have to mandatorily transfer the balance in electronic credit ledger from the old entity to the new entity. In case of sale, you have to mandatorily do that. Now friends, is this demerger? The answer is no. Because in case of demerger, the old entity's PAN will be different, the new entity's PAN will be different. Now friends, here this is not demerger. It is only you are applying for separate GST registrations. So therefore, here the PAN number remains the same. In effect, if I could like to rephrase, in case of demerger and sale, there is a change in constitution of business. But in case of applying multiple registrations from a single registration number, there is no change in the constitution of business. The PAN number remains the same. So in case of demerger and sale, the transfer was mandatory. From the electronic credit ledger of the old entity to the new entity, the transfer was mandatory. However, in this case, rule number 41A, which is newly being inserted, the transfer is not mandatory. If you want, you can shift the electronic credit ledger's balance from this GST numbers to both these GST numbers if you want. It is at your option. Taking additional registration is your option. Transferring the credit from the old entity to the newly registered GST numbers is again at your option. Now friends, the next question comes is, if at all you want to transfer, should you transfer it to both the entities? Again, it is your option. If at all you want to transfer, you can transfer to any of the entities you wish to, even though you have taken 2 new GST numbers. Still, if you want, you can transfer the credit ledger balance only to one entity or to both the entities. Point number 3. Agreed. I do not want to transfer to all these entities. I want to transfer only to one of these entities. Let's suppose I want to transfer only to additional place of business 2. How should I transfer? Now take the assets ratio. You have to transfer in the asset ratio which is there between this GST number and this GST number, and the total assets whatever is there, you will have to transfer only in the assets ratio. So friends, here as regards as taking multiple registrations is concerned, it is optional. Transferring the credit is concerned, it is optional. To how many units you want to transfer, it is optional. But if at all you want to transfer, you have to transfer in the assets ratio. Again here, assets means not only those assets on which ITC is being availed, it is the total assets what is there. So let's have a look at rule number 41A. A registered person who has obtained separate registration for multiple places of business and in accordance with the provisions of rule 11 and who intends to transfer, that means it is not mandatory, it is optional. Either wholly or partly, that means either wholly or partly. How much you want to transfer, it is your wish. The unutilized input tax credit lying in his electronic credit ledger to any or all of the newly registered place of business. You need not necessarily, if at all you want to transfer, you need not necessarily transfer to both the units. It is your wish. How much you want, you can transfer. To any or all of the newly registered place of business, he shall furnish within a period of 30 days from obtaining such separate registrations. So the time limit is from the date you apply for registration. Within 30 days, if you want to transfer, do the work. The details in form GST ITC 02A. Friends, in the case of sale and demerger, it was ITC not 2. In this case, it is ITC not 2A. 02A. Electronically on the common portal, either directly or through a facilitation center. So this is about rule number 41A. Provided that the input tax credit shall be transferred to the newly registered entities in the ratio of value of assets held by them at the time of registration. So at the time of registration, whatever is the value of assets which is held by them, only on that ratio you are supposed to transfer. For the purposes of this rule, it tells you value of assets means the value of the entire assets and not only those assets on which ITC has been availed. The newly registered person shall, that is the transferee, shall on the common portal accept the details furnished by the registered person, the transferor, and upon such acceptance, the unutilized ITC will be transferred from the old entity to this new GST number. From the old GST number to this new GST number, it is going to be transferred. So friends, what is the difference between rule 41, which spoke about sale, demerger, etc. at that time when you transfer, and rule 41A? We have already discussed all the differences. It is just summarized over here. The title it is transfer of credit on sale, merger, amalgamation, lease or transfer of a business. Here it is transfer of credit on obtaining a separate registration for multiple places of business within the same state. Is there a change in constitution? Answer is yes, rule 41. 41A, there is no change in constitution. Is it mandatory? 41 is yes, 41A is no. Who are the recipients? It is to all transferees. You cannot choose the transferees to whom you want to transfer the credit. It is to all transferees. Here it is to chosen transferees. Form needs to be filed, ITC not 2, here it is ITC 02A. Liabilities. Now, if at all you want to transfer this credit, in the case of sale, demerger, etc., here there should be a specific provision for transfer of liabilities which has to be certified by a CA or a practicing CMA, and a certificate needs to be obtained. Here there is no such specific provision for transfer of liabilities because there is no change in the constitution of business. It remains within the same PAN. So where is the question of change of liabilities? Where is the question of transfer of liabilities? So since there is no point in transferring liabilities, there is no point in requiring a CA and CMA certificate certifying that the liabilities have been transferred. So this is all about rule 41A, which has been newly inserted. Next point, again dealing with section 18. As regards this transfer of business is concerned. Now friends, let's suppose there is a case of death of the proprietor. There is a case of death of the proprietor. Now friends, death of the proprietor, let's suppose Mr. A. Now this business is going to be continued by Mr. B, who happens to be his son. Can you call this also as transfer of business, and you can transfer the balance lying in electronic credit ledger of Mr. A to the electronic credit ledger of Mr. B? Can you call this as a transfer of business in GST law? If the answer is yes, that means if you can call this as transfer of business, then how do you transfer the balance from electronic credit ledger of the old entity to new entity? Because old entity should file ITC form 02, but now the proprietor has already expired. Who is going to file ITC 02 for the credit to be balanced, for the credit to be transferred from the old entity to the new entity? So two questions which rise up. One, can death of the proprietor, transfer of business on account of death of the proprietor, be called as a transfer of business as envisaged in section 18? Question number 2, if the answer to the above question is yes, then who is going to file form ITC02, because the proprietor has already expired and credit can be transferred only when ITC02 is being filed. Friends, in case of sale of business, in case of amalgamation, demerger, this issue doesn't arise. This issue arises only in a proprietary concern where the proprietor has expired. So friends, this is a circular which clarifies and which tells you that yes, transfer of business on account of death of the proprietor will also be reckoned in this transfer of business under section 18. And who needs to file ITC02? It is the legal heir. It is the legal heir of this proprietor who is supposed to file ITC02. So, availment of ITC, change in constitution. Does 18 subsection 3 include transfer on account of death of the proprietor? Because it tells you scenario is change in constitution of registered person due to sale, merger. See, death, is death included over here? On specifically reading 18 subsection 3. See friends, why does this question arise? This question arises because if you read the wordings of 18 subsection 3, it tells you change in the constitution of registered person because of sale, merger, demerger, amalgamation, lease or transfer of business. Now the question is, does this transfer of business include transfer on account of death of the sole proprietor? If yes, who is going to file ITC02? So here the circular 96/15/2019, it has analyzed the provisions. First, it had a look at section 29 of the CGST Act, which deals with cancellation. Let's have a look at the wordings which are mentioned over there. It tells you, friends, as regards as cancellation is concerned, either the registered person himself can apply for cancellation or the proper officer suo motu will initiate the cancellation. Now, when the registered person himself wants to apply for cancellation, what are the grounds wherein the registered person can apply for cancellation? So, here the grounds which are mentioned in section 29 tells you where the business has been discontinued. So, if the business is discontinued, the registered person can apply for cancellation. Transferred fully for any reason, if it is either it is discontinued or transferred fully for any reason, including death of the proprietor. So friends, here the CGST Act, when it is seen as a whole, the wordings of section 29, transfer of business includes transfer of reason of death of the proprietor. So now friends, please try to understand. The circular is trying to answer a question which is raised in section 18 subsection 3. But for answering 18 subsection 3, the circular is trying to find out at the other sections, other places in the law, does transfer of business include death also? If at the other places inside the same law, if transfer of business includes transfer on death of the proprietor, then even in 18 subsection 3, the intention of the lawmakers would have been to include death of the sole proprietor, any transfer of business on account of death of the sole proprietor in this transfer of business. So section 29, the wordings have been used is transferred fully for any reason including death of the proprietor. So therefore, in the CGST law, transfer of business includes transfer because of reason of death of the sole proprietor. Who has to file ITC02? Again, we have a look at section 29, where the proper officer may either on his own motion, that means suo motu cancellation initiated by the officer, or on an application filed by the registered person or by his legal heirs. That means where the cancellation application could either be filed by the registered person or it could be filed by the legal heirs. When will legal heirs file the cancellation application? When the registered person has expired. Only then the legal heirs is going to file the cancellation application. So therefore, the law is giving a hint that in case on death of the proprietor, any form which needs to be filled can be filled by their legal heirs. So taking recourse from section 29, we come to two conclusions. One, transfer of business on account of death of the proprietor is also a transfer of business as envisaged in section 18 subsection 3. 2, who needs to file form ITC02? Section 29 tells you that in the event of death, the legal heirs can file cancellation application. Taking the same logic, in case of death of the proprietor, form ITC02 also can be filed by their legal heirs. Now, liability to pay the taxes. So friends, section 85, this principle is very simple. Let's suppose transfer is taking place on this particular date. Now, any liabilities pertaining to this period, that is the period before the transfer took place, any liabilities pertaining to this period, whether found out during this period or found out subsequently. Let's suppose this transfer is taking place on 1st of January 2020. Now, any liabilities up to this period, whether found out before 1st January 2020 or found out after 1st January 2020, both the transferor and the transferee is going to be liable to discharge this liability, for the simple reason that whenever transfer of business takes place, the liabilities are also transferred, whether found out on the same day, whether found out before transfer or after transfer. Friends, the point is only that the liability already existed. It is only that it is found out later on. But as on 1st of January 2020, the liability did exist. So, in case of transfer, up to the date of transfer, the transferor and the transferee are liable for making good the liability. Any liability which is pertaining to this period, after the transfer took place, it is only the transferee who is going to be liable. It is only the transferee who is going to be liable to discharge these liabilities. So, this is all about the circular 96/15/2019. One change in job worker. Now friends, as we all know, principal can send the goods to job worker, or the supplier of principal. The principal can instruct his supplier to directly deliver the goods to the job worker, and in accordance with section 16, in the case of bill to ship to concept, when the job worker is receiving the goods, it is as good as though the principal has received the goods and he can take the input tax credit. Now friends, the goods which are being sent to the job worker, if it is inputs within a period of 1 year, or if it is capital goods within a period of 3 years, it needs to be returned back to the principal. If it does not, there are certain special capital goods on which the time limit of 3 years doesn't apply. Now, if it doesn't return back to the principal, inputs within a period of 1 year, capital goods within a period of 3 years, then it shall deem to be supply. It shall be deemed to be a supply which is made by the principal to the job worker on which day? On the date on which the inputs or capital goods were initially sent. On the date on which the inputs or capital goods were initially sent. So, this is the provision which all of us are aware. Now friends, what is the change in this? The change in this is, this 1 year can be further extended by another 1 year by the commissioner. This 3 years can be extended by another 2 years by the commissioner. So, this extension is possible. Inputs 1 year plus 1 year, capital goods 3 years plus 2 years. So, this extension is a change which is there. Section 143, extension of time limits for the goods, either inputs or capital goods, to be returned back to the principal by the job worker. Next, a slight change, input service distributor. Now friends, as an input service distributor has to distribute the credit to all the recipients. This we have already discussed in portions, in apportionment of credit, that is proportionate credit. Now input service distributor, he has to distribute the credit to all the recipient units in some formula basis ratio. The formula happens to be ITC to be distributed is equal to ITC multiplied by turnover of the recipient having nexus with ITC during the relevant period divided by turnover of all recipients having nexus with ITC during the relevant period. So, this is the formula based on which the distribution is going to happen. Now friends, as regards as the turnover is concerned, it excluded central and state excise duty, it excluded VAT. So, these were the two things prior to amendment it was excluded. Now friends, CST was accidentally omitted. Over here. So, therefore, now this turnover will exclude central and state excise duty, VAT and CST as well. Friends, the same thing what we have seen in explanation to rule 42 and 43, the value of exempt supplies will exclude your excise duties and VAT. There was an accidental omission of CST, which due by making an amendment in the rules, they have included CST as well, as in the value of exempt supply will exclude CST as well. The same thing as regards as distribution formula for distributing the input service distributor's credit is concerned. Here the turnover will exclude central excise, state excise and VAT prior to the amendment. Post amendment, it will exclude central excise, state excise, VAT and CST.